Inflation, inflation, inflation. That was the big news headline yesterday. What does it mean for markets and money, and more importantly, interest rates? That's coming up. Let's start off with the market first this morning, as markets did sell off fairly sharply yesterday on this news that we all of a sudden we had 6.2% rate of inflation, much stronger than expected. Of course, this transitory inflation number was expected to be, well, transitory, but it's certainly starting to be a bit more persistent than originally expected. Of course, higher inflation, higher cost, that has to be ultimately either passed on to consumers in terms of higher prices, or companies have to start reining in costs. That would mean a reduction of labor. So again, inflation in and of itself is an economic brake, and that is going to slow earnings. And of course, a lot of this advance in the markets just in recent weeks has been on the premise that margins are good and earnings will be exceptionally strong going into 2022. That may not be the case. And the one thing the market has not focused on just yet is the impact of these higher estimates by Wall Street that will be brought down into 2022. Declining earnings growth, of course, is going to be impacted by high prices. That's going to suggest a revaluation sometime next year. However, in the short term, interest rates are going up here. That did impact, of course, stocks the most that are really impacted by high rates of inflation. We saw that yesterday in technology stocks in particular, which were down sharply yesterday. Of course, those are also the stocks that have had the biggest run. Of course, as we talked about on Tuesday, that we did trigger our money flow buy signal, but we said so far we still had a MACD buy signal in place. That is very close to triggering as well, which would confirm the money flow sell signal, which would suggest potentially a retracement of prices back towards the 50-day moving average at a minimum here over the course of the next couple of weeks. Of course, in that time period, we've got the holiday period coming up, we've got options expiration next Friday, and we've got mutual fund distribution. So plenty of reasons for markets to sell off here over the next few days. Watch that closely. Yesterday, we also talked specifically about taking some money out of our bond portfolio as well, shortening our duration. TLT, which is the 20-year bond equivalent, has had a very nice rally from about 141 up to about 150 here just in recent weeks. It's been a very nice rise for bonds. That had gotten very overbought. Yesterday, we talked about taking some profits out of that because of the fact it was overbought and triggering a money flow sell signal. Of course, that inflation print yesterday accelerated that sell-off yesterday. And again, we reduced that position, raised some cash, which shortens the duration of our bond portfolio in particular, kind of hedges some of that interest rate risk. We don't expect there to be a lot of downside here to bonds, probably potentially back down to the 143 area. That will probably provide a very good entry opportunity to add fixed income back to portfolios as we head into next year. If we're right, and inflation begins to slow economic growth, and the Fed becomes more aggressive on rate hikes, that's going to also slow economic growth as well. That will lead to a deflationary pressure in the economy, slow economic growth, and that will pressure interest rates lower over the course of 2022. So again, as we've talked about before, while a lot of people are saying that the bond bull market is over, it's likely going to be one of the better returning opportunities in portfolios next year. I'm your host, Lance Roberts, for 3 Minutes on Markets and Money. See you back here tomorrow.